Good evening everyone. It's a pleasure to have you this evening. My name is Jonan Kandwanaho and I'm the team leader, chief servant at Janoki Holdings Limited. And at Janoki Holdings Limited, we offer credit. We give loans, we offer financial relief, whichever term you may want to use. But that's what we do. And we look forward to serving you. If you're stuck, you have a consignment, you have an LPO that you would like to fund, you have a supply that you're struggling with, you want that bridge financing, and not just that, but in a quick, short time, we actually serve you. And our intentions are actually to serve you with integrity. It's not to fleece you, it's not to defraud you of your money or your business or your property, but rather to keep you in business as we keep in business. And that's what Janoki Holdings Limited is about. You can always check us out at www.janokiholdings.com, and you're always available to serve you at Ntinda and Mulago Business Center branch. Great. As I delve into today's topic, as I said a while ago, these talks of recent have been tailored or targeted towards people who are lending money, whether formally or informally. Is that, for example, if you're lending money, you need to listen, you need to watch, so that you can learn one or two things that can actually bless you, but also help you grow, because you're not meant to keep stagnant where you're at. And that's what informs our today's topic. There are many models that people use, that different companies use to lend money. But there are specifically a number of models that are used by money lenders to lend money. So this talk is targeted to a person who is lending money, to tell you of the model, or if you plan to join the business, what model that you can use to actually help you become profitable, but also help you support your clients keep in business. You see, it's a symbiotic relationship. If you're growing and your clients are not growing, then there's no growth at all, because before you know it, you'll serve none. Before you know it, you will not have anyone to serve. Why? Because you cause the failure or the collapse of your clients or potential clients. So if I want to get more business in the future, or even as of now, I have to keep in business as I keep my clients in business. That's why I share with you the model that works, the model that is good, that will not make you accumulate a lot of money and then get the clients out of business, but it will help you keep in business as your clients keep in business. So there are three models I'm going to take you through. The first model is, you can call it the market model. The market model, or the market small loan model. Such a model is the one that is targeted towards markets that sell, let's say, agricultural produce, markets that sell small merchandise, markets that basically they're targeting small scale business people or micro businesses. So such a model is that you give small amounts of money, the ranges of 100,000, 200,000, 300,000, and basically you really ask for collateral. The collateral that the person can actually give you is either their stall in the market, the matoke stall, or the banana stall, or the stock that they have in their small shops as collateral. Because first, if you're asking for a car logbook, most of the people who are playing in this kind of business or this kind of category do not have collaterals that are feasible. They don't have car logbooks, they don't have land titles that you may want as collateral. But also, realize that the amount of money that they usually ask is not as much. If you're talking in the ranges of 200,000, 100,000, or 500,000, you cannot ask someone for a land title for such an amount of money. So you actually have to look at what it is they're going to finance, then you give them against that thing. So it's an interesting model, because you see, the payment period is usually daily, so someone pays per day. So what you do is that you compute the interest and the principal that you're giving this person, and for the time that they are taking it, maybe 3 months or 4 months, and then you spread that amount. And the person can actually know what it is or how much it is that they are meant to actually pay per day. So in a way, this does not constrain the person. It also does not constrain the person who is running the business, the money lending business. Because the key matter or the key issue in money lending is you have to keep liquid. You have to be liquid, because if I come for money and I bounce, or I bounce because you don't have money, I will not tell my client about you, or my friend or my colleague about you. Why? Because I bounced. You didn't have money. More so, it wasn't when you take me through the process and you reach a moment of giving me money and you don't have the money. You're just playing around. You see, you assessed me, I paid perhaps the fees and all that. I went through the process, but you've reached the final point, but you don't have the money. I'd rather you actually tell me from the word go that, you know what, I don't have the money at the moment, or I cannot serve you at the moment, rather than wasting my time. So this is very key, because you see, you're collecting back your money on a daily, but also it does not accumulate to constrain the client that you're serving. So both of you silently keep in business. Now, we don't run that kind of model. There are a few challenges that come along with that model, because there's a lot to learn. First of all, there's no standard way on how you can actually evaluate or value that stall, that Matoke stall, or that Irish stall, or that consign, that stock in someone's shop. There is no a standard format that you can actually use to value, to establish the value of that stock in that shop, or the value of the stall in the market. That's a big challenge. So as you're giving the 300,000, 500,000, or 1 million, you do not exactly know what it is you're giving the loan against. You can actually estimate, you can call someone to help you estimate, but ultimately you don't have an accurate valuation of that kind of item that is acting as a collateral. That's a big, big challenge. So what do I advise? Maybe the other challenge that comes along with this kind of model is that collections is a little cumbersome, because you see, you have to, as you give a number of people 500, 300, 400, you have to establish the operational cost versus the amount of money that you're making in a business. Because it might be cumbersome to collect as one individual from maybe 100 people, or 200 people, or 300 people in a market, or anywhere where you're serving them from. It might become cumbersome, and you can imagine it gets tight if you're collecting this money on a daily. Like, you have to collect this money every day. So it becomes very, very tight and very cumbersome. It's a little tedious. And the return on investment, that can as well be spelled out depending on the rate you lend at. But that can also be discussed for another day. My key thing is it is cumbersome. So you have to be ready to soil your hands. You have to be ready to take it on. You have to be ready to actually get involved or employ a number of people. So in doing that, you have to be sure that the profits that you're making are not being spent in the operations. Because you need a number of people, so you need to employ them, you need to facilitate them. It's a big cost. So you have to look at the amount of money you're collecting vis-a-vis the people that you're paying to do the collections and the serving of the clients. So it's a huge, huge challenge. So what do I usually advise if you're operating such a model? The advice when you're operating such a model, but also the other last challenge is that someone can easily close shop. Wake up one morning, the stall is worth maybe 200,000, and like, you know what? Let me leave this Calgary market or in Tinder market. I go to Boyogere market. So someone is mobile, but just because you give small money, this is a little not as a big risk. But if you give significant money beyond the stall of a person, the person can easily leave the store or sell it to someone else, and she goes. Usually it's a she, and she goes. She can sell the store to someone else, and she goes. And you only know her. You don't know this new person who has bought the store. So it's good that you involve the authorities. It's good that you involve the chairpersons. It's good. So the key solution that I usually advise for the few guys that I interact with is that make sure these people have their circles, their associations. And when you're lending, you lend to the association. To the association. So select a few individuals in the association that you actually lend the money. Because you see, not all the members in the association will actually close shop. Not all of them will run away. So if you lend to all the members, it becomes very easy to hold each other accountable, and then they actually pay through their chairperson. Or they assign one person to actually pay. So if you're lending that category, or if you're running that kind of model, it's important that you lend to a group rather than individuals. Second model. The second model is a little related to this one, to the market micro model. But this one is also a small loans, in small individualized loans. Now, this kind of loans, you give them to individuals, not necessarily markets, not necessarily, they're actually individuals. They could be business people, they could be in their own errands, working somewhere, but it's small money. So what happens that you have a limit of the amount of money that you actually give out, but it doesn't have a collateral. It doesn't have a collateral. I've seen people operate this, but it's too risky. They have collateral. The key thing that they ask for is national ID and perhaps a recommendation from the chairperson where that person stays. Majorly, some of the guys that receive this kind of monies have businesses, but also some individuals who are employed, but employed in a low category of jobs. This could be askaris, security jobs, where they earn maybe in ranges of 500,000 or 400,000, 300,000. Now, the challenge with this is that the turnover of such people is very high. I come for a loan of 1 million shillings, and I know that, you know what, I am leaving this company. I'm going to join another company. So the turnover is very high. So if you give these individuals loans based on what it is they're earning from these companies, it's a big challenge, and it's very risky. So it's a more loan thing, usually 200, 500, 1 million. As you may see, the collaterals are not there, or they are very risky. I'll give you an example. You lend money against a mobile phone as a collateral, maybe for a loan of maybe 200,000 or 500,000. But before you know it, that person perhaps stole this phone from someone. The things happen. I'm talking from the real experience. So someone stole a mobile phone from someone, and you don't know what they did to that person. Perhaps they killed him. And you come and get this collateral, and the person gives you the mobile phone. And before you know it, the person definitely can actually not pay. So when they fail to pay, you actually come and sell the phone to someone else. As you sell the phone, someone puts a SIM card, and they're tracking them. They track the serial number, and they arrest it. And you can actually close shop. But not only close shop, but also get imprisoned. You can enjoy prison for nothing and lose your business, like close shop. Really, go down the drain because of a very funny mistake. So what really happens is that I advise that if you lend against such items, maybe a mobile phone, it's important the person you've lent to actually first puts the SIM card, and they double check, they verify that actually I put my SIM card, the serial number has confirmed it, or you've actually called me and I've confirmed. And then in case of any eventuality, I'll show that I have the loan forms, the documents are very clear. Even the person had the SIM card in this phone, so it's a transaction thing. It's not involved in any criminality that is related to this kind of mobile phone. So that's the kind of advice I give, but it's not conclusive. It's not ultimate. So what I tell you is that if you've been operating it and you're successful in it, well and good. But you may need to go to a most feasible or a most efficient model of running business. And this is the last one. The last one is what Jonaki Holdings Limited operates. Now this one operates on a monthly basis. And usually we give as low as maybe 500,000 as the minimum amount, and as much as, based on whether you're a return client or not, give 50 million for new clients, and we can stretch it maybe to 100 and 150 or 200 million for a return client. But such a model is that you're looking at the collections on a monthly basis. It also has its own challenges, but it's a model that I've found that it's not as cumbersome. It also helps give this client a breathing space, because you can imagine if I give you a loan of 100 million and you have to pay on a daily, it becomes cumbersome, because probably where you put the money, you don't expect it tomorrow. You expect it after a week or 2 weeks or probably 1 month. So it becomes cumbersome to actually collect per week or per day. So what we do is that we collect per month in this kind of model. But also too, is that the money is fully secured. That's why I say it's the most feasible or the most advisable model to operate. So the money is fully secured, because if you're coming for a loan of 50 million and you have a car logbook, it's worth putting the caveat on the car logbook. It's worth valuing your car. It's worth valuing your land title. Why? Because the amount of money that we have in question is significant. So this is the model that we operate, and I advise that you look at considering this model especially if the other models are not working for you. And also the advantage with this kind of model is that you don't collect interest only. So you make sure that you have to keep in business. As I said, that this business of lending money operates on liquidity. If you don't have liquidity, you're out of business. So in serving the client, it's important to know that, you know what, as the clients are paying back, they're not only paying interest, but also paying part of the principal, because you run on this principle. It is this principle that keeps you in business. If you don't collect this money, then before you know it, clients will come and you don't need as many, especially if you're just starting. Probably you're starting with a capital of 50 million and you just get 2 or 3 clients and you're stuck. Now you can imagine if these guys are only paying you interest at the end of the month and they're not paying anything on the principal. Time is going to come, the client is going to look at the amount of money they have given you as interest, and they're going to tell you how much they have given you, how you have charged them for a long time, and how they have almost paid up the principal, and it will be back and forth. So what I advise is that collect on the principal as you collect on the interest. Now this will help the clients because it reduces on the burden that they have, the loan burden that they have, but also it will help you keep liquid and keep in business. This model is very, very significant. It's very, very important. It's very, very feasible because your money is fully secured. The only disadvantage, of course there are quite a number, but one disadvantage that is really, really outstanding, since I might not highlight all of them because of the time, is that this is the most prone model to conmen. It is the most prone model to conmen. Fraudsters, conmen target this kind of model. Why? Because first, it involves a lot of money. Secondly, they can put you on pressure during the assessment of their loans, and you can actually easily fall into their basket. They'll put you on pressure. You can imagine someone comes on a Friday afternoon, he has a land title, he wants a loan of 100 million, and he starts putting you on pressure as if he applied for this loan on Monday. So that you can fall into the mistake and they fleece you. So most of the fraudsters target this kind of model. So whereas it is profitable, whereas it is peaceful, whereas it gives peace to the client as well as to you as an operator, it is the most prone model to the fraudsters and thieves. So what do I advise in this case? As I come to a close of our today's session, I advise that if you're running this model, or if you're planning to run this model, it's important that you formalized. Now you look at, you go and check out on my YouTube, Jonan Kandwanaho, and check out my YouTube on formalization, how you can actually formalize your business. You need to be formalized because you cannot put a caveat on a car logbook or land title, put a mortgage on a land title if you're not formalized. 2, it is important that you have a clear process that you go through to assess a client. You are not supposed to look at the collateral because the collateral will not pay you. The collateral will only pay you if you're foreclosing on it. And if you have to keep in business, you have to foreclose on a few clients as much as you can. On as few clients as you can. Because remember, by the time you reach a moment of foreclosing on a client, it has gone out of hand. And you wouldn't want to clash with as many clients. So the intention is not the collateral. The intention is to fully assess someone's cash flow so that you can ascertain that they have the ability to actually pay back. Very, very finally, it's important to know that, you know what keeps you in business is the clients that you serve. So you need to serve your clients very, very well, so that through referrals, they can refer you to a number of other clients. Now, our business is run on referral system. Person can come to Jonaki Holdings even if the rate is slightly high and he leaves the lower rate just because they know that ultimately Jonaki is not interested in my property, or perhaps they have trust in Jonaki because they know their property is actually secure. So this business that we run, money lending, thrives on trust. Clients need to trust you first before they can entrust you their properties, before they can do business with you. So it's important that as you look at this model, study it properly, do proper assessment, but also get someone to walk the journey with you. Get someone to walk the journey with you. Because before you know it, you might face big challenges. But if I face a challenge and I share it with you, then you can actually jump over it. You can actually survive. You can actually thrive. You can actually survive some of the big losses. because school fees is very expensive in this kind of business, because you're talking about money. You're talking about money. Every mistake that you make, your money is at risk. So it's important that you get someone that you can walk the journey with. Even if they're charging you, let them charge you, because ultimately you're going to make money. But also you're going to save yourself from losing money and getting out of business. So I love you guys. Check us out at www.jonakiholdings.com, but also check out Jonan Kandwanoho, my YouTube. Subscribe, like, learn one or two things, but above all, implement. Go out there and implement. So our today's topic was the most feasible money lending model, and that was the last model that Jonaki operates the same, so that you can actually thrive and keep in business, serve the clients well, but also get served as well. I love you all. Have a great Friday evening, and enjoy the rest of the weekend. Blessings, and the good Lord bless you. I speak a blessing over you, over the works of your hands. Go out there and serve the communities, the country, and the world at large. But above all, keep in business. Don't be a martyr. Go and thrive in Jesus' name. Amen. Have a great evening. I love you all. Blessings.